I'm now joined in Cape Town by Graham Bell. He is a strategist at Old Mutual Equities. Graham, thanks so much for making the time to join us. Just mentioned the euro dollar and, of course, looking at the FOMC minutes that's due later on today. Are you expecting any more clues with regards to the timing of the US and when they might start to hike those rates?
I think the Fed minutes will confirm what a lot of people have been drawing the conclusion from the payrolls data for last month, which were very strong, much stronger than expected, and also the wage rates picking up. And so I think it's virtually certain that the Fed will finally be able to hike rates in December, and I'm pretty sure the minutes will point in that direction.
Speaking about the wage inflation there, we did see some inflation numbers that came out of the US, and this was yesterday. It was sitting at about 0.2 for the month of October. It was within line with what market commentators had expected. Do you think this will have any significant impact again on the timing of the US Fed?
Well, yes, we've seen a whole spate of inflation numbers coming out from the Eurozone, the UK and the USA. And the thing to watch now with those inflation figures is the core rate rather than headline rate. So headline rate of inflation has been coming down across the board in many economies because of the fall in the oil price. As that starts to fall out of the base, and in fact probably you start seeing that might even start seeing some inflationary pressures in due course from that side. Once that starts to happen, then the core rate becomes that much more important. And for instance, in the Eurozone, core inflation rate is 1.1. In the UK, it's also 1.1%, and in the US, 1.9%. So a long way above the zero headline rates of inflation, or even negative rates that we've been seeing in some of those economies. And this will definitely inform the opinions of the Fed and the Bank of England, for example. And that's why most people expect certainly the Fed to hike next month, and that the Bank of England will be not too far behind. Obviously, in the Eurozone, there are other issues. There's still a lot of spare capacity. The labor market's not nearly so tight as they are in the USA and in the UK. So they will still have their foot on the easing gas pedal rather than the brakes. So at the moment, that's where the trend is. And what does that mean? It means that, for instance, one way of expressing that is you can see in the two-year note spread, the spread between the two-year Treasury bill yield and the two-year Bund yield is now at the highest level since 2007. It's about 0.75%. Doesn't sound too much, but that's quite significant relative to where we've been for a long time. And that is forming people's opinion about where the currency should go, particularly the dollar versus the euro and sterling. And the dollar has actually had another lurch up in recent weeks. And that's been having pretty negative effect on commodity prices once again.
Graham, what is all
overall, I'd say, yes, the Fed's ready to go, and that's, the impact of that is going to be felt through markets and volatility for a while.
Graham, so what does all of this mean for equity markets? You mentioned volatility. You were saying that the Fed certainly looks like they are ready to go. So as an investor looking at these global markets, what does this exactly mean?
I think it still means for developing or emerging economies, there's still worries and still volatility, including for our market. And that's particularly true, I think, for the resource stocks, which have put in a truly dismal performance now for several years. And we can't really see much changing on that front for the time being, particularly with another move up in the dollar and another move down in commodity prices. Copper prices, pushing down towards $2 a pound. You've seen stocks like Anglo American break into double-digit territory for the first time in a long time. BHP Billiton falling below 200 Rand. One's tempted to buy at these levels, and some of the value investors have been buying at these levels, but we don't really see the earnings supporting those stocks at this stage, with the prices still falling, and another set of very poor earnings results still coming out in the next reporting periods. So it's going to be tough, and so that really keeps pushing you into the stocks that have higher earnings potential, good dividend yields, sort of quality businesses, global businesses, which are not tainted by the resource bug, or the negative on the resources.
While we're sticking with the resources, Graham, tomorrow is a big day for Lonmin with regards to that vote regarding the rights issue. Any takeaways from you regarding the developments for that particular counter?
Well, I don't really follow specific stocks that closely, but Lonmin, if anybody's going to be buying a Lonmin or selling Lonmin, it's purely for trading purposes. This is something where you could make a quick buck if you're lucky, and you could lose your shirt if you're unlucky. This is a business operating right at the very marginal end of the market. The outlook for platinum platinum group metals at the moment is not great. There are some positives, European car sales and so on picking up, but this is not for the long-term portfolio. It's a trader stock, and that's all I could really contribute to the discussion.
Well, thanks for that, Graham. That was Graham Bell. He's a strategist at Old Mutual Equities.